Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer. Imagine this. You wake up tomorrow and suddenly, borrowing money gets cheaper. Your mortgage, your car loan, even your credit card payments could shift. Sounds good, right? Well, the Federal Reserve just announced its first rate cut of 2025. But here's the real question. Will this move put more money in your pocket, or set the stage for bigger problems in the economy? Let's break it down. Hi everyone, welcome back. Today, we're diving into one of the biggest financial stories of the year. The Federal Reserve has officially cut interest rates by 0.25 percentage point. This is the first rate cut since late 2024, and it could mark the beginning of a new cycle. But before you celebrate or panic, let's unpack what this decision really means for you, your wallet, and the overall economy. On September 17th, the Federal Reserve lowered its benchmark interest rate by 0.25%. Bringing it down to a range of 4% to 4.25%. If you're not following this closely, you might wonder why this matters. Well, the Fed's interest rate is like the price of money. It influences how much banks charge you for loans and how much they pay you for savings. When rates are cut, borrowing gets cheaper, but savings accounts often earn less. So why now, after holding steady for 9 months? The Fed's main job is to balance inflation and employment. For much of the past 2 years, they kept rates high to cool down inflation. But recently, the economy has shown signs of slowing. Job growth has been weaker, with several disappointing reports in a row. Companies like John Deere and automakers have announced layoffs. Consumers are feeling the pinch from tariffs that raised the cost of everyday goods. In short, the Fed cut rates to support the job market and prevent the economy from sliding toward recession. Here's where it gets personal. If you're planning to buy a house, good news. Mortgage rates may come down gradually. That could save you thousands of dollars over the life of a loan. If you already locked in a fixed mortgage, your rate won't change. But refinancing could become more attractive. Thinking about a new car? Lower rates make auto loans a bit cheaper, although car prices are still high because of tariffs on steel and auto parts. Most credit cards have variable rates, which move with the Fed's decision. This means your interest charges could drop slightly. Not a huge amount, but over time, it adds up. There's another side too. Savings rates usually fall after a Fed cut. That means the interest you earn in a high-yield savings account could shrink. For investors, Wall Street often cheers lower rates because they boost corporate profits and make stocks more attractive compared to bonds. But remember, the Fed cut rates because the economy is weakening, so volatility could remain. But here's the catch: a rate cut isn't a free lunch. If borrowing gets too cheap, people spend more, and that can push prices back up, leading to more inflation. If companies still face high costs from tariffs and supply chain issues, rate cuts might not be enough to bring jobs back. And if the economy slows further, the Fed may be forced to cut even more aggressively. Fed Chair Jerome Powell himself said that tariffs are more of a one-time price shock rather than long-lasting inflation, which gives them room to cut. But uncertainty remains high. This decision also has global consequences. The US dollar may weaken, making American exports more competitive but raising import costs. Other central banks, like the European Central Bank or Bank of Canada, may respond with their own moves. Emerging markets could see capital flows shift, creating ripple effects worldwide. So, what does this all mean for you? If you're borrowing, you'll likely benefit. If you're saving, expect smaller returns. If you're investing, get ready for both opportunities and risks. The Fed's quarter-point cut might sound small, but it signals a big shift in policy. From fighting inflation to supporting growth. And that shift could shape your financial future for months, if not years, to come. Now, I want to hear from you. Do you think this Fed rate cut is the right move, or is it too little, too late? Drop your thoughts in the comments below. And if you found this breakdown helpful, don't forget to hit like, subscribe, and share this video, because understanding money means taking control of your future. Thanks for watching, and I'll see you in the next one.